In this video, we're going to look at moving averages. These are one of the simplest and most common tools of technical analysis, and they're very easy to apply to your chart when you're using the MT4 trading platform. The first thing you need to do once you've opened up a chart is come up to the top of the screen and click on the indicators icon. If you've used the moving average recently, it will appear in this list towards the top. If not, come down the bottom and click on the trend grouping and you'll find the moving average in there. Once you click on that, a new window opens up, and this is where you can change some of the parameters of your moving average. The first one highlighted here is the period, so we can set the moving average to whatever period we choose. The shift function allows you to shift the moving average either backwards or forwards in time. The moving average method in MT4, we have 4 different types of moving average that we can apply. We can use a simple moving average, an exponential moving average, a smoothed moving average, or a linear weighted moving average. Now, if you'd like more information about all of these, and you'd like to know how they're calculated, come back to the main MT4 platform, click on Help, then Help Topics, and that will open up the user guide. When you open up the Analytics folder and then the Technical Indicators subfolder, if you scroll down to Moving Average and then click on that, it gives you explanations in great detail of the calculation for each of those different types of moving average. Now, in addition to applying different types of moving average, we can also choose whether to apply the moving average to the closing price, which is most common, or to the opening price, or the high or the low. We even have a couple of other options here. We can apply the moving average to the median price, or what's known as the typical price, or the weighted close. You've got the option to change the color of your moving average, change the line style, and change the weighting. Now, for now, we'll apply this 200 period simple moving average based on the close. Now, a 200 period moving average is often used to give an indication of the broad, longer term trend of the market. As you can see here in the Eurodollars, it was quite a good indication of the long-term upward trend between early 2006 and mid-2008, when suddenly prices broke down quite sharply. Now here we have a 55 period simple moving average on the Eurodollar chart. And it demonstrates quite nicely this idea that moving averages are most useful when a market is trending or turning from one direction to the other. But when a market is moving sideways, moving averages really aren't so useful, as they tend to sit broadly in the middle of the congestion band. Of course, this depends on the length of the moving average being used. Now, as we've seen already with the 200 period moving average, a single moving average can be used to indicate the broad trend of the market. You can also use a single moving average as a very simple trading signal, buying when prices move above the moving average and selling when prices fall below. Now, a slightly more advanced technique involves plotting 2 moving averages on the chart. So let's add a second moving average. We've already got a 55 period here. Let's add, say, a 34 period. Now, if you plan on taking trading signals from using 2 moving averages, what you need to look for is for the shorter term moving average to cross above the longer term moving average from below. That gives you a buy signal. And then a sell signal is given when the shorter term moving average crosses below the longer term moving average. It works well enough in a market with strong trends, but it can result in quite choppy trade if you're trading in a market that enters into a phase of consolidation. Some traders like to refine this technique further by adding a third moving average. During a bullish phase, a buy signal is given when the mid-length moving average crosses above the slower moving average, or the longer term moving average. So as you can see here, when the green line crosses above the red, that's our buy signal. An exit for longs is signaled when the shortest term moving average crosses below the mid-length moving average. So in this case, it's when the blue line crosses below the green. That's giving you the exit signal for the long position that you held. Similarly, during a bearish phase of market activity, a sell signal is given when the mid-length moving average crosses below the slower moving average, and the exit is given when the fast moving average crosses above the mid-length moving average. It's really up to you what periods you use for your moving averages. For the example shown on the chart, I've used a 21, 34 and 55 period moving average because they are Fibonacci numbers and we were interested in looking at the relationship between the moving averages, but you can use any combination of periods that you like. Well, this has been a very basic introduction to moving averages. They're a very useful tool, but you will benefit if you play around with the parameters and try out some of the different techniques we've mentioned in the video. Good luck.